Now here to discuss the multifamily market is Richard Counselman. Richard is Vice President and Partner at SL Nussbaum Realty Company. Please welcome Richard Counselman.
Thank you, Larry. Good afternoon. My name is Richard Counselman. I'm Vice President of Multifamily Development at SL Nussbaum Realty Company. I'm honored to have been asked to give the multifamily presentation this year. And with that being said, let's hop right into the report. I'll start with this. Yes, multifamily was hot in 2018, and really for the last few years. I do want to make a quick distinction. For this presentation, I'm going to focus on market rate and conventional properties. We are not going to cover the affordable workforce housing product, which remains very strong in our region, and there are a handful of us keeping busy in this sector, including the Lawson Companies, the Franklin Johnston Group, and SL Nussbaum Realty Company. Let's start out by taking a look at our vacancy rates compared to nearby cities like Richmond, Raleigh, Durham, and Greensboro. Look at where Hampton Roads was in 2009, dark black line. Now look at where we are in 2019, right about the same place, just below 6%. And a lot of product has come online since then. So our vacancy rate, for the most part, has remained low compared to these North Carolina cities, which started the decade higher, but have tightened up over the years. Now on the rent side of the equation, Hampton Roads and Richmond show a nice steady increase, only recently breaking the $1,000 a month average rent mark. Look at all of us a decade ago. I think our military presence, while we depend on them heavily, has kept Hampton Roads rent growth modest, but has enabled us to stay on pace with absorbing the steady flow of new product that has come online. That's not the case in Raleigh-Durham, where huge economic growth, especially in the last 5 years, and other factors have resulted in a more dramatic rise in rent levels. We have seen a big shift in the types of amenities offered by new developments. Pools, fitness centers, and business centers are no longer the only amenities. Other modern amenities include dog washing stations, pet sitting services, smart home features, rooftop features, car charging stations, and package delivery systems to accommodate orders from Amazon and other online retailers. This emergence of an entirely new class of amenities and the live, work, play concept is more recent, and we now know that people are willing to pay up for it. Absorption, net deliveries, and vacancy. First, we'll look at the south side. The orange and blue bars, absorption and net deliveries, go with the left-hand side of the key, and the green line, vacancy rate, goes with the right-hand side. So you can see between 2014 and 15, a lot of activity, followed by a strong absorption period, then vacancy falling between 2016 and 17, and it has stayed low since. Generally speaking, we're staying on pace with absorption of the net deliveries, again, showing current vacancy between 5 and 6% on the south side. Rent growth on the south side, blue and green lines go with the left-hand side of the key, and the orange bars go with the right-hand side. And you can see we've been in a steady 1 to 2% year-over-year rent growth pattern over the last decade. A little different story on the peninsula. We started a 7.5% vacancy in 2010, reaching upwards of 10% in 2015, and only now are we coming back down to that 7% range. So the moral of the story here is that we have typically seen the peninsula operating in the 90 to 93% range, and sometimes lower, and the south side typically 94% and better. Now, even though the orange bars here are smaller compared to the south side, meaning the rent is lower, the rent growth over the last few years on the peninsula is between 4 and 5% versus 1 to 2% on the south side. One reason for that is the south side's larger inventory and more product coming online every year, creating more competition, which constrains the rent growth. This is what I like about the peninsula, though. The federal government's decision to grow our Navy from a 287 ship fleet to 355 ships, and the announcement of Newport News Shipbuilding's contract to build 2 new aircraft carriers, not to mention the 400 new hires per month that they started in 2018. They are all going to need a place to live, which bodes well for the peninsula's multifamily market in the near future, and I like this news for the industrial market as well. Transaction volume in 2018 exceeded $665 million. We are still proving to be a solid market for multifamily investors in newly constructed and vintage product. Here are a few of the 2018 sales. Latitudes Apartments in Virginia Beach sold for $66.5 million, 448 units at a cap rate of 5.63%, approximately $149,000 per unit. This deal traded just a few years prior to that for $125,000 per unit, so you can do the math. In Chesapeake, Cottage Trails apartment at Culpeper Landing sold for just over $30 million, 183 units at a 6.2% cap rate, approximately $164,000 per unit. On the peninsula, Compass at City Center in Newport News sold for about $46.5 million, 396 units at a 5.74% cap rate, about $118,000 per unit. And in Hampton, Trail Creek sold for over $44 million, 301 units at a cap rate of 5.8%, $147,000 per unit. Here's a look at a few developments that are currently underway or delivered in 2018. Mezzo Apartment Homes in Virginia Beach, developed by SL Nussbaum Realty Company, 282 units, expected to start delivering the units this spring. Premier Apartments is Armada Hoffler's third multifamily deal in the town center in Virginia Beach with 131 units, which completed in the fourth quarter of 2018. This was the only ground-up high-rise in our region. The Choices, 252 units in Virginia Beach, developed by Jaffe Kaplan Fleeter, delivered in June of 2018. And the Mark, 264 units in Virginia Beach, developed by the Breeden Company, delivered in the spring of 2018. So what's in the forecast for multifamily in 2019? While the multifamily market is still going strong by most measures, there are some factors that are causing and will continue to cause things to cool off a bit. More specifically, rising rates and rising construction costs. Although the graph here shows you that rates are comparable to 10 years ago, I can assure you that construction costs are not. According to Construction Analytics, residential construction costs have increased approximately 24% between 2014 and 2018, and they expect that trend to continue for the next few years. That will have a chilling effect on new construction, especially when you consider our moderate rent growth. It has not stayed on pace with construction cost. This graph shows residential construction starts for the U.S. as a whole. The steepest decline in construction starts during 2018 was in the residential sector, which fell by 15.3%. More specifically, construction of new multifamily units contracted 25.3% in the fourth quarter of 2018, the fourth consecutive quarter of annual decline. If net deliveries slow down a bit, I think stronger rent growth and tighter occupancy are in the cards, and I think we'll continue to see new development in select locations. As for proposed developments on the south side, this map shows what looks to be a lot of activity, almost 4,000 units if they are all built over the next few years. And although some have strong development groups behind them that are very capable of making them happen, I'm not entirely convinced that all of these will come to fruition, mainly for the reasons that I just mentioned. The peninsula map shows proposed development totaling almost 2,100 units. Again, despite strong sponsors, there's no guarantee that all of them will make it. In closing, while the market in 2019 will not be as scorching hot as it was in 2018, the sun is still shining, very much so. Although the times are certainly more interesting at the moment, I believe the multifamily market in Hampton Roads will remain strong, and we can look forward to fair weather in the forecast. I'd like to thank you all for your time this afternoon, and last but not least, I'd like to thank those that helped put this presentation together. Thanks.